We will conclude Chapter 7 by examining the end of a long-term asset's life cycle, that is, its disposition. We previously examined the acquisition, where we answered the question, is it proper to capitalize or expense an expenditure? Assuming we do capitalize the expenditure, we examined its use. Depreciation in the case of a tangible asset, amortization in the case of an intangible. At the end of the asset's useful life, it will be disposed of. It will be sold if we can generate some proceeds. If we cannot, it will simply be retired, meaning it's no longer used but can't be sold, or it could be exchanged, traded in for another asset. Let's assume an asset costs $20,000 and the total accumulated depreciation is 8. The net book value would be 12. At what price will this asset sell? The answer is, it depends. What is the asset's actual economic value? $12,000 is the asset's net book value. That is its accounting balance sheet value. But actual economic value depends upon a variety of factors. When we talk about actual economic value, we use the terms fair value or fair market value and often abbreviate it FMV. Understand that it's very unlikely that the two will be equal. An asset's economic value will very likely differ from its net book value. As a consequence, when we do the accounting for a sale transaction, we will see a gain or loss. A gain will arise if the asset is sold for more than net book value, a loss if the asset is sold for less than net book value. To clarify, a gain is treated like a revenue account. It is reported on the income statement and its normal balance is a credit. In contrast, a loss is treated like an expense. It too goes on the income statement, but its normal balance is a debit. It is a reduction to our equity. Let's look at an example. Assume Misty Company sells a piece of equipment that it has owned for 3 years. The sale price is $78,000. The equipment originally cost $100,000 and accumulated depreciation is $30,000. Net book value on the balance sheet is therefore $70,000. The amount of gain or loss on the sale is calculated by comparing the sale price to the net book value. In this case, we see that we will have a gain because the sale price exceeds the value on the balance sheet. The journal entry required to record this sale is a variety of steps. We will record the proceeds received. We will record the cash of $78,000. We next will remove the asset cost from the books. This requires a credit to the equipment for the original $100,000 cost. Third, we need to remove accumulated depreciation from the books. Recall that accumulated depreciation is a contra asset that has a credit balance. In order to remove it from the books, we need a debit. The final journal entry looks like this. Debit to cash for the proceeds received. Credit to the equipment, removing it from the books at its original cost. Third, we debit accumulated depreciation in order to zero out that account. And then finally, we plug gain or loss in order to balance our debits equal to our credits. What if instead the equipment had been sold for $61,000? Let's recompute the gain and record the journal entry. Our proceeds are the $61,000. Our net book value is still cost minus accumulated depreciation, or the $70,000 as it was before. In this case, because our proceeds are less than the net book value, you can see the result is that we have a loss. The journal entry is similar to before. First, we're going to record the cash proceeds of $61,000. Second, credit to equipment for its original cost. Third, we will remove the accumulated depreciation from the books with a debit. And as before, we need to balance out the journal entry to make debits equal credits. And in this case, we need a $9,000 debit. And if we recall our rules, a debit is a reduction in net income. That is a loss. So in summary, first, debit the proceeds received at fair market value. Second, credit the asset at its original cost. Third, we will debit accumulated depreciation that corresponds with the asset sold. Lastly, we will record gain or loss depending upon the relationship between the proceeds and the net book value.